Welcome to The Explainer. Today, we're tackling something absolutely crucial. We are going to decode the vital legal requirements of Vietnam's law on accounting, specifically document number 88-2015/QH13. Whether you're a business owner, a corporate director, or a finance pro, we've designed this breakdown to cut right through the heavy legal jargon. We're going to get straight to exactly what you need to know to keep your business fully compliant and running without a hitch.
But first, I want you to honestly ask yourself, do you truly understand this law? Because the legal and operational stakes here are massive. This isn't just about making sure your spreadsheets balance at the end of the month. It is about the literal survival of your enterprise. A basic misunderstanding or a simple compliance slip-up, that can literally paralyze your business overnight. So we really need to take this seriously.
So here is our game plan for today. 1. An overview of the accounting law. 2. The prohibited acts. 3. Vouchers and ledgers. 4. Reporting and inspection. And 5. How to legally organize your accounting team. Let's dive right in.
All right, Section 1, Overview of the Accounting Law. Before we get into the really strict compliance metrics, let's lay down the foundational definitions.
Article 3 of the law splits the accounting world right down the middle into two distinct realms. On one side, you've got financial accounting. This is all about gathering and processing data for external eyes. We're talking tax authorities, your investors, auditors, people outside the company. On the flip side, we have management accounting. This is strictly for your internal strategy. It provides the financial reality check that management needs to make actual business decisions. You've got to understand this split because the law treats how you handle and report these two streams very differently.
Moving right along to Section 2, Prohibited Acts. We're shifting gears here because this is the highest stakes area of the whole law. Under Article 13, there are some hard lines you just cannot cross. Let's rapid fire through the biggest offenses. Number 1, forging, falsely declaring, or altering any accounting documents. Just don't do it. Number 2, and this one is huge, maintaining two separate financial ledger systems for the same period. No shadow books. Number 3, intentionally destroying your records before the legal retention period is actually up. And lastly, bribing, threatening, or coercing your accounting staff into cooking the books. The fallout for any of these? Severe.
And look, these aren't just abstract philosophical guidelines. These rules are explicit, incredibly detailed, and totally unambiguous in the legal text. As a business owner or a director, you carry the ultimate responsibility to make sure absolutely none of this is happening under your roof.
Okay, Section 3, Vouchers and Ledgers. Let's transition from those high-stakes prohibitions to the actual day-to-day reality of your finance team.
Now, Article 18 is pretty dense, but we can easily translate it into a simple golden rule for filling out physical vouchers. Ready? If you are writing an accounting voucher, you must use ink, but absolutely no red ink. You cannot use whiteout or make erasures that hide the original text. And you have to write continuously, meaning no skipping lines, and if there's blank space left over, you have to cross it out. The whole point here is to make it impossible to tamper with the document after the fact.
But hey, what happens if you genuinely make a mistake in the ledger? It happens, right? Well, covering it up is totally illegal. Under Article 27, you only have 3 legal ways to fix an error before you submit your statements. First is the strike-through method. You draw one single straight line right through the error so you can still read what was there, write the correct number above it, and sign it. Second is the negative number method, where you write the wrong number in red ink or parentheses to cancel it out, and then write the correct entry. Third is the additional entry method, where you just write a supplementary entry to cover the missing difference. That is literally it. Those are your only 3 options.
All right, so your documents are perfect. Now, how long do you have to hold on to them? Article 41 gives us a very strict timeline, so treat this as a direct order. You have to keep your internal management records for at least 5 years. For official financial statements, accounting data, and audit reports, you're holding those for a minimum of 10 years. And for any documents that have specific historical, economic, or national security significance, you keep those permanently.
Which brings us to Section 4, Reporting and Inspection. This is where your company's internal data meets the state authorities. If you remember one number from this whole explainer, make it 90. According to Article 29, you have exactly 90 days from the end of your annual accounting period to submit your financial statements to the state agency. You've got a strict 3-month window to consolidate, finalize, and file. Put a massive circle around that deadline on your corporate calendar.
Now, getting inspected by the state sounds terrifying, doesn't it? But the law actually throws you a bone here by putting strict boundaries on the authorities. Under Article 36,
A standard accounting inspection is legally capped at a maximum of 10 days. If their case is incredibly complex, sure, they can extend it, but only by 5 more days tops. Plus, the inspection team has to stick strictly to the scope they announced in their initial decision. They can't just endlessly dig around and disrupt your operations for months.
Finally, Section 5, Accounting Organization. Let's look at the strict human resource rules governing who is actually legally allowed to touch your books.
Articles 51 through 54 are a tale of two extremes. On one hand, becoming a chief accountant requires clearing a very high bar. You need specific degrees, a proper certificate, years of practical experience, and rock-solid professional ethics. But on the flip side, the law is hyper-specific about who is prohibited from these roles to prevent conflicts of interest. It explicitly bans minors, certain convicts, and, listen to this, the family members of the director or manager. Your parents, spouse, kids, siblings cannot run your books. Oh, and your storekeepers and cashiers? They cannot double as your accountants. Separation of duties is non-negotiable.
So the bottom line here is that building your accounting department isn't just an HR puzzle. It's a strict legal compliance issue. If you hire your sister-in-law to run the books, or you let the warehouse manager also handle the financial accounting, you're directly violating the law.
Before we wrap up, I want to leave you with this fantastic quote from Article 5. It really captures the entire philosophy of this law. It demands absolute truthfulness, complete transparency, and a totally unbroken chain of economic reality from the very first day you open your doors to the day you close them. Every single financial move has to be captured perfectly.
So let me ask you, is your internal accounting really fully compliant today? Take a hard look at your organization right now. Are your retention policies actually being followed? Are your ledger mistakes being fixed the legal way? Is your finance team totally free of prohibited family members? Use what we went over today to audit your own operations, because when it comes to accounting law, precision isn't just a nice-to-have, it is absolutely mandatory. Thanks for joining me on this explainer, and we'll see you next time.